November 2024. Nvidia's market cap hits $3.6 trillion, more valuable than the entire German economy, more valuable than Amazon and Meta combined. A single company that makes chips is now worth more than the GDP of France. And everyone's celebrating. But I'm looking at something else, something that makes my stomach turn, because I've seen this exact pattern before. March 2000. Different companies, different technology, identical math. Let me show you what I mean. A major AI company raises $6.6 billion in funding, biggest funding round in history. The investors? Microsoft puts in $1 billion. Nvidia puts in hundreds of millions. Amazon, Salesforce, others pile in. The headlines scream, AI revolution confirmed. Stock prices surge. 1 week later, that same AI company announces a massive deal. They're buying $4 billion worth of Nvidia chips over the next 18 months. Nvidia's stock jumps 7% in a single day on the news. Wait, let me say that again slower. Nvidia invests money into an AI company. That AI company immediately uses that money to buy Nvidia's products. Nvidia records this as revenue. Nvidia's stock soars on record AI chip demand. You see it yet? It gets better. Microsoft also invested in that AI company, right? And Microsoft just happens to be providing the cloud infrastructure that the AI company runs on. So, Microsoft gives them money, which they use to pay Microsoft for cloud services. Microsoft records this as Azure growth. Microsoft's stock jumps. The money isn't flowing into AI, it's flowing in a circle. This is called round-tripping, and it's the exact same mechanism that destroyed Enron, the exact same structure that collapsed the dot-com bubble, the exact same playbook. But this time, it's not just a few companies. It's the entire AI sector. And the numbers are so big they're hard to comprehend. I started digging, really digging, into SEC filings, into quarterly reports, into the footnotes nobody reads. And what I found isn't just concerning, it's catastrophic. Because every major AI company is doing this. Every major tech giant is participating, and the total amount of circular capital flow is somewhere north of $2 trillion. Not 2 billion, trillion with a T. Here's why this matters to you, right now, today. If you own any tech stocks, and statistically you probably do through your 401k or index funds, you're exposed to this. Your retirement is exposed to this. Your financial future is tied to companies whose revenue is increasingly just money moving in circles. And circles break. They always break. In 2000, the Nasdaq fell 78% from peak to trough. $5 trillion in market value evaporated. Retirement accounts were cut in half. People lost their homes, their savings, everything. But here's the thing that keeps me up at night. The dot-com bubble was mostly speculation on future profits. This AI bubble is different. This one has actual revenue, actual earnings, actual proof that it's working. Except the revenue is fake. The earnings are circular. The proof is an illusion. And when the circle breaks, not if, when, the carnage will make 2000 look like a practice run. Let me show you exactly how deep this goes. Let's talk about CoreWeave. You've probably never heard of them. That's intentional. CoreWeave is a cloud computing company that specializes in AI infrastructure. In 2023, they were valued at around $2 billion. Respectable, nothing crazy. Then something remarkable happened. Nvidia invested $100 million into CoreWeave. Within months, their valuation exploded to $19 billion. That's a 950% increase in less than a year. What changed? What revolutionary breakthrough justified that valuation? Here's what changed. CoreWeave signed a $2.3 billion deal to buy Nvidia chips. Let me walk you through the accounting magic. Nvidia gives CoreWeave $100 million. CoreWeave uses that money, plus additional debt financing from banks who trust CoreWeave because Nvidia just invested in them, to buy billions in Nvidia hardware. Nvidia records the chip sales as revenue. Record AI demand, the headlines declare. Nvidia's stock surges. Nvidia's $100 million investment is now worth $1.9 billion on paper because CoreWeave's valuation went parabolic. Nvidia just turned $100 million into $1.9 billion in 12 months, not by creating value, by creating a circle. But it gets more layered. CoreWeave doesn't just buy chips and sit on them. They rent them out as cloud computing power. To who? To AI startups. Which AI startups? The ones funded by Nvidia's venture arm. You're starting to see it now, aren't you? Microsoft invested in OpenAI, $13 billion total. OpenAI doesn't have its own data centers, so they rent compute from Microsoft Azure. Last year alone, OpenAI paid Microsoft over $3 billion for cloud services. Let's do the math. Microsoft gives OpenAI $13 billion. OpenAI pays Microsoft $3 billion per year for infrastructure. At that rate, Microsoft gets their investment back in just over 4 years, but they also get to record that $3 billion as Azure growth revenue, which pumps their stock price, which makes their $13 billion investment worth multiples more. Meanwhile, OpenAI charges customers for ChatGPT. Where does that revenue go? Partly back to Microsoft for more compute. The circle keeps spinning. Amazon does the same with Anthropic. $4 billion investment. Anthropic builds on AWS, pays Amazon for compute. Amazon records it as AWS growth. Microsoft stock jumps. The money isn't flowing into AI, it's flowing in a circle. And Wall Street is eating it up. Because on paper, it all looks legitimate. These are real transactions, real revenue, real signed contracts. The accounting is technically legal. The SEC filings are compliant. But the fundamental question remains, where is the actual value creation? I spoke with a former Enron accountant, yes, that Enron, who now works in forensic finance. He looked at the AI sector structure and said something chilling. This is more sophisticated than what we did. We had offshore entities and special purpose vehicles. They don't even need that anymore. They're doing it in plain sight. And because it's tech and AI, everyone just nods and calls it innovation. Here's the test. If Nvidia stopped investing in AI companies, would those companies still buy as many chips? If Microsoft stopped funding OpenAI, would OpenAI still rent as much Azure? The answer is no, and everyone knows it. But here's what makes this truly dangerous. It's not just the tech giants playing this game anymore. The entire financial system has been pulled in. Banks are now financing these circular deals, lending billions to AI startups backed by these tech giants, secured against chip purchases from those same tech giants. The banks feel safe because Nvidia is backing it or Microsoft is involved. Private equity firms are piling in. Pension funds are allocating capital. Your retirement fund probably owns shares in companies whose revenue is 40% circular. And then there's the second-order effects nobody's talking about yet. Let me show you where this gets really dark. There's a company called Lambda Labs, small AI infrastructure startup. In 2023, they secured $320 million in financing to buy Nvidia chips. The deal was backed by Nvidia itself. Nvidia guaranteed the loan. Think about that structure for a second. Nvidia essentially co-signed a loan so that Lambda could buy Nvidia's products. If Lambda defaults, Nvidia takes the hit, but Nvidia still gets to record the chip sale as revenue today. This is called vendor financing, and it's the exact mechanism that destroyed Lucent Technologies in 2001. Lucent gave customers loans to buy Lucent equipment. Revenue looked amazing, growth looked unstoppable, until the customers couldn't pay back the loans. Lucent's stock fell 96%, from $84 to $1.26. Now scale that to the entire AI sector. I pulled the numbers. In the last 18 months, Nvidia has directly or indirectly financed over $12 billion in chip purchases through investments, equity stakes, and loan guarantees. That's $12 billion in revenue that only exists because Nvidia funded it themselves. But here's where it compounds into something catastrophic. Those AI startups aren't profitable, not even close. OpenAI lost $540 million last year despite having ChatGPT. Anthropic is burning through cash. Inflection AI just got acquired for parts. Stability AI is in chaos. These companies have massive revenue, but revenue isn't profit. They're spending more than they make because they're in an arms race to build bigger models, buy more chips, rent more compute, hire more engineers. And who benefits from that arms race? Nvidia, Microsoft, Amazon, the same companies that invested in them. It's a brilliant scheme. Create companies that are structurally unprofitable but generate massive revenue for the parent ecosystem. Keep them alive with continuous funding rounds. Record their spending as your growth. But it only works if the funding never stops. The moment the capital flow stops, these companies collapse. And when they collapse, all that revenue vanishes overnight. Here's the timeline I'm watching. OpenAI is reportedly trying to raise another $7 billion at a $250 billion valuation. Anthropic needs another funding round. CoreWeave is looking for more capital. Lambda Labs will need refinancing. They all need continuous injections of fresh capital to keep buying chips, renting clouds, and generating revenue for their investors. This is not a sustainable business model. This is a Ponzi scheme with GPUs. And the cracks are already showing. Last month, Microsoft quietly reduced their Azure commitments to OpenAI. Not by much, just 15%. But in a growth story, even a 15% reduction is a red flag. It suggests Microsoft is starting to question the return on their $13 billion bet. Google just announced they're slowing AI infrastructure spending. Not stopping, slowing. But in a sector where growth is supposed to be exponential, slowing is the first sign of doubt. And then there's the ultimate tell. Insiders are selling. Nvidia's CEO, Jensen Huang, has sold over $700 million in Nvidia stock in the last 6 months, not through scheduled sell programs, discretionary sales. He's selling into strength while retail investors are buying the dream. Microsoft's Satya Nadella sold $285 million. Amazon's Andy Jassy sold $180 million. These aren't small position trims. These are massive liquidations. They know something, and they're getting out while the valuations are still sky high. But here's what terrifies me most. It's not just about tech stocks crashing. This is bigger than Nvidia or Microsoft or the NASDAQ, because the entire economy is now tied to this AI bubble, and I can prove it. December 2024. A small AI startup called Inflection AI quietly shuts down its flagship product. You didn't hear about it because the news was buried. They raised $1.5 billion. They had Microsoft backing. They hired top talent from DeepMind. And they couldn't find a business model that worked. So Microsoft just absorbed the team and killed the product. $1.5 billion gone. Just like that. This is the canary in the coal mine, and nobody's paying attention. Because here's the truth that the AI hype can't hide anymore. There is no killer application yet. ChatGPT is impressive. I use it. You probably use it. But are you paying $20 a month for it? Most people aren't. OpenAI has 100 million weekly users. Know how many are paying subscribers? About 10 million. That's 10%. And those 10 million paying users generate maybe $2.5 billion in annual revenue. Sounds good until you realize OpenAI is spending $7 billion per year on compute, salaries, and infrastructure. They're losing $4.5 billion annually on a product with 100 million users. Scale that across the industry. Anthropic, Stability, Midjourney, Character.ai, all burning cash, all searching for the business model that justifies the valuations. Microsoft is betting that enterprise AI will save them, that companies will pay massive fees for AI integration into Office, Teams, Windows. But early adoption rates are disappointing. Most companies are experimenting, not buying. Google is betting on AI search ads. But if AI answers your question directly, you don't click on ads. Their entire revenue model is threatened by the very technology they're investing billions into. This is the paradox. AI might be revolutionary, but it might also destroy more value than it creates for the companies building it. And investors are starting to notice. Last week, Sequoia Capital published a research note. They estimated that the AI industry needs to generate $600 billion in annual revenue to justify current valuations. Current actual revenue? About $100 billion. And most of that is the circular stuff we talked about. There's a $500 billion revenue gap and no clear path to closing it. The whispers are getting louder. Smart money is rotating out. Hedge funds are shorting AI stocks. Insiders are selling. The momentum is shifting. Here's what I think happens next. One of the major AI startups, my bet is on one of the smaller ones, maybe Stability or Character.ai, will fail to close their next funding round. Not because they're bad companies, but because investors finally ask the question, when does this become profitable? When they can't answer that question, the funding dies, the company dies, and suddenly everyone realizes these companies are mortal. That's when the contagion starts. If one AI company can fail, all of them can fail. The narrative breaks, the faith evaporates. Nvidia's revenue guidance drops because their customers can't raise capital to buy more chips. Microsoft's Azure growth slows because AI startups can't afford the compute. The circular flow stops. The stock prices crater, not gradually, violently, because they're so overvalued that there's no support level. Nvidia at $145 is priced for perfection. Any crack in that perfection and it falls to $80, maybe $60. And when Nvidia falls, it takes everything with it. The S&P falls, the Nasdaq crashes, retirement accounts bleed, margin calls trigger forced selling, the gamma squeeze reverses into a death spiral. I'm not saying this happens tomorrow. Maybe it takes 6 months, maybe a year. But the structure is unstable. The math doesn't work. And history shows us that unstable structures always collapse, eventually. So, what do? If you're heavily invested in tech, especially AI-related stocks, you need to understand your exposure. Look at your index funds. Look at your 401k allocations. You probably have way more Nvidia, Microsoft, and AI exposure than you think. I'm not telling you to sell everything and hide in cash, but diversification matters. Portfolio protection matters. Having positions that don't correlate with tech matters. Because when this unravels, it will be fast. You won't have time to react. The circuit breakers will trip. The markets will halt. By the time trading resumes, the damage will be done. The $2 trillion AI lie isn't that AI doesn't work. It's that the business model doesn't work. It's that the revenue is circular. It's that the valuations are based on faith, not fundamentals. And when faith breaks, markets don't drift down. They collapse. I watched it in 2000. I watched it in 2008. The patterns are always the same. Euphoria, overvaluation, circular capital flows, leverage, denial, and then the moment when everyone realizes the emperor has no clothes. We're in the denial phase right now. The whispers are starting. The insiders are selling. The cracks are forming. The question isn't if this unravels, it's when, and whether you'll be positioned to survive it when it does. Because the AI revolution might still happen, just not at these valuations and not with these companies. The bubble always pops. Always. And this one is bigger than most people realize. Stay alert.